Welcome back to Invest in a Moment, the podcast where we break down big money moves, market trends, and financial news. So whether you're saving for that dream vacation, your kid's retirement, or a healthy and comfortable retirement phase, this podcast is all for you, and we're here to discuss some key financial topics. People often say that long-term investing is simple. Just buy and hold, no issues. But why is it that investors sometimes struggle with this concept? And this is a topic that we'll be discussing today. And joining me is someone who we all may know and has joined us before. We have...
Hi, my name is Simon. I'm the Chief Business Officer of GAX MD. I'm glad to be back here. Thank you for the invitation.
Oh, so before we kick off this topic with long-term investing, I love to throw some ice-breaking questions, and I want to hear from you and your candid thoughts, right? So if I could just kick off a quick discussion topic. If you could describe long-term investing in one word, what would it be?
Well, it's not easy. It's not easy, definitely. It's something that involves a lot of factors. I think the obvious one everyone knows is the time required. We're talking about more than 5 years. Most people get it, that investment horizon, but most people may not necessarily get it is the part in terms of the necessary behavior required. So we're talking about something that we are wired as a human, and it's something against our human nature. So long-term investing sounds like something that is, just like when you want to bake a cake, you just put it inside an oven and just set it and forget it and then come back later, right? So for long-term investing, it's more like it requires you to be a lot more involved, but not in an active way, more in terms of making sure that you have the preparation required to navigate that journey and also to be able to withstand any market fluctuation.
Okay, very interesting. So definitely a lot of factors there.
Yeah.
Right. As we get into our first segment, I want to just ease into this discussion topic again, where in your experience and your expertise, what is the common misconception or the stereotype, or what do most people get wrong when they think about long-term investing before they even begin?
Yeah, that's a very good question. I think long-term investing, like in terms of the period wise, people will understand the requirement to stay invested for a period of time, at least 5 years and above. But most people misunderstand in terms of the behavioral requirement when it comes to staying invested for that long period of time. So we're talking about, maybe I can give you an analogy, like for example, fitness, right? Let's say we talk about if you have a plan to do workout for the next 5 years, I think you will know that in 5 years' time, you will be getting in shape, right? If you just working out for the next 5 years. But the challenge is this. Let's say on a fine Tuesday, you felt like you were having a headache, your muscles sore, and you don't see any progress, So do you still keep going to work out? So muscle soreness is something similar to like market volatility in the world of investing, where market volatility can actually cause you to be upset, and you may give up in terms of the position that you have. And that may actually resulted in a panic selling just to sort of, to feel comfortable, right? To not feel the pain, like for example, the muscle pain. Yeah, so basically for long-term investing is that you need to have the discipline, just like fitness. You know that eventually you're going to be there. But when your muscles sore, when you have headache, when you don't feel like any progress, that is where it is important to stick with your workout, your routine. That will basically help you to ensure that you can achieve your long-term success.
Okay. I like the analogy you give. I think it gives everyone a clear understanding of volatility and fitness goals, right? Yeah. So what are your personal fitness goals?
Well, to be in better shape than the last 40 years. So the last 40 years.
So I hope this transposes to your long-term investment strategy, right?
Yes.
So something you pick out there is that, so when I say long-term investing, I automatically assume that yes, it is a long duration of time. But why do people still think that or rather, let me rephrase, there's no right long investment period. Long to me can be 5 years, long to you could be 10.
Yep.
Right. So why is it that people think that, they behave differently? Right? Why do they behave differently depending on their own personal time frame, or all these factors say, hey, I'm sore today, I'm sore next week? Like what could cause that?
Yeah, so actually when it comes to long-term investing, there are two components, right? So the time aspect of it and also the duration, the behavior aspect of it. So when it comes to time, most people know that over time, market will grow, right? So time can basically power the compounding effect of the investment return. And at the same time, also time can provide stability or help to reduce the volatility in the portfolio. So some people may take it easy, right? Because knowing that I have a long way to run, right? In order to, I can be a bit more relaxed, or I can take a bit more risk, this and that. So but if you were to compare the other requirement, which is the behavioral side, right? We always say that when it comes to success, right? Discipline is required. Discipline in terms of in terms of how you behave, especially when market are not in your favor. Like, for example, when market keep going up, right? I think it doesn't really test your strength, right? The real test is when market actually go the opposite, and that's where you can see that maybe 90% of the people would tend to be panicked, and they may tend to do something out of what they have set to do.
Okay.
For example, they could have thought about dollar cost averaging, when let's say market correct by 10%, but because of the fear, or because they try and predict that, hey, this may actually fall further, so I may delay my dollar cost averaging decision, or I may want to actually invest more now because it's actually so much cheaper. So that kind of ad hoc decision may or may not break that discipline, right? So, but certainly it basically may contribute to mistakes, which can basically derail their discipline, and also eventually the result that you are likely to get over long term.
So, with all these fitness analogies and comparing dollar cost averaging and volatility and behavior, maybe you can also share an example of a time where, when you're speaking to investors, why do you think that long-term investing is so difficult? In theory, it sounds easy, right? But why, when real life in applicable situations, how do you reassure, or in a way educate the investor that, hey, these are the steps for long-term investing?
That's a very good question. Yes, long-term investing is difficult because it goes against our human nature. As a human, we are wired to react, right? Let's say when there is a threat, we will tend to take shelter, right? When there's a sales, we will tend to buy, right? So market always trigger us to do something, right? So the key is that it's difficult for human to not do anything when there are so many triggers in the market. That is the thing. So for investors, is that for them to really be able to control their reaction, is basically they need to understand, that is the emotional pitfall, or what we call behavioral impact of investing, and it play a very big role in basically in terms of the endurance that the investor have to be able to survive through the long term. So yeah, so it's easier said than done, I would say. You can have a plan, but when the test comes, our human nature may take precedent. And also another thing is that experience also does contribute to that factors, where the short-term experience, which may be positive, but sort of overrule the theory, or the logical or the plan. So our own experience, or our other people's experience, right, may actually overrule what the actual facts required, or what's required to be able to manage that volatility. And short-term experience can be, or I would say short-term experience is not something that easy to sort of like overrule, right? If you feel good, right, or if you have made a good move, like for example, you sell when the market drop and the market drop further, right? So you may felt like, hey, I've beat the market, I've done something better. So, but when the market recover, when you miss the recovery, right, then that is when that actually this experience may not be applicable anymore. And it's difficult for you to admit that this experience is wrong, because you have experienced that it seems to work. Yeah. So So that pocket of experience or good experience, or we call it bad decision, but turn into a lucky situation, may not helps. So that also something that can actually cause difficulty for people to remain invested over long term.
Oh, well, I think you gave a very descriptive answer right there. So there's a few things that you said I really want to nitpick out. So you mentioned short term and long term. Obviously, the topic of today is long term investing, right? But how do maybe give you a brief example. How does short term or medium term market movements affect a long term investment decision?
So the first thing I think as an investor is that if you're a long-term investor, right, you should not overreact to short-term and medium-term market movement. The second thing is that you have to understand market move, right? Market move up, market move down, market move sideways. Market have to move. And what caused the movement in the short to medium term? So mainly market movement are driven in the short to medium term by sentiments, right? Sentiments, headlines, or even fund flow, or even economic surprises, right? So all this can be considered as surprise. I mean, it's temporary, or something that is hard to predict. And the thing is that when you look at the fundamental of the company that you are investing in, the fundamental may not have changed, but the prices of the company may have moved because of this short-term kind of movement, right? So it's important to understand that over long term, we are investing in something more fundamental, like the growth of the company. And over short to medium term, market doesn't move solely based on fundamental. It moves mainly based on the things that are temporary, the things that are unpredictable. So if your investment mode swing like the market investment mode, then technically you are not investing into the growth of the underlying investment that you're investing in. You are just basically investing based on what people think or what people feel is supposed to be the case, which over long term may not translate to a solid, trajectory.
Don't be a sheep.
Yeah.
So if I tell you, hey, invest in this asset class I found, where do you find it from? Oh, TikTok. Well, so that is very much trend and following trends, right?
Yes.
So I do understand, to summarize, that for long-term investing for long-term investment case, you shouldn't be swayed too much by short-term or medium-term factors, right? Any decision could be a right one, could be a wrong one. You could be lucky, that sometimes is the case. But fundamentally, if you have a sound strategy and you believe in the long-term growth of an investment or a portfolio or any sort of ETF bundle package, then definitely ready for the long term. And I think that's something that is key to understand.
Yeah. That's right.
So as we move along, this next topic can be a little bit technical. So I think Simon will give examples and some real world applications for all our listeners out there to better understand. So let's talk about risk and volatility. Right? Risk does not equal volatility and vice versa.
Yeah.
When investors say they're worried about risk, there can be so many risks, but maybe you can share examples of what they are usually reacting to.
So when it comes to volatility, most people confuse it with risk, the risk of losing money. So volatility is just market movement, is temporary. Most people react to volatility because they saw something negative, and it's natural for them to react. That's perfectly normal. The thing is that when it comes to volatility, it's not something that is easy to predict. When you try and predict the volatility of the market, most of the time it's hard because anything can influence, right, the market movement in the short term. So the part about risk is that if, let's say, you treat volatility as something that scared you away from investing, then it's really become a risk, because the risk is you may miss out on your financial goal. For example, if you have a plan to achieve this amount of money in 10 years time, right, and if the market is volatile, so you decide not to invest, so that may actually cause you to miss out on the best day of investing, and eventually it will basically your long-term goal may not be achieved. And that is the risk, because that is where it is real, because you are not achieving the goal, and that's where the main risk for you should be, rather than the market volatility is as a risk factor, because market is something that we all have to realize that is definitely volatile.
So as we move along, from what you've observed so far, what are the most common mistakes that quietly damage long-term investment outcomes?
Yeah, most common one is sell during uncertainty. So the problem is you don't know when you're going to get in back. after you have sold during those kind of circumstances. And besides that, what I noticed also is that chasing trend is also something that people used to do, and it basically hurts your portfolio returns over long term. Other than that is switching in and out from a strategy. So that doesn't help also. Besides that, holding too much cash also dilute the return over time. And I think most investors, they did not basically pay a lot of attention in terms of the fee as well, the fee portion of their investment portfolio. So that may not have an immediate impact in their portfolio returns, but over long term, right, it can basically help to dilute, the return that they are supposed to get.
By distinguishing volatility and risk, maybe if we can break it down one step further, let's zoom out a little bit, right? Can you maybe share examples or list down what factors define risk versus what factors define volatility, right? So if I ask you, someone comes and tells you, hey, I feel this is very risky because the market is too volatile. That itself is a double-edged sword because it could mean one of many things. So now that when you're talking to investors and we just talked about volatility and risk, if someone says, hey, I don't want to invest in this because it's too risky, the market's too volatile, that itself is a double-edged sword, right? So if we break down these two things, how do you help people to distinguish between volatility and real long-term risk?
So volatility is market movement. Market move up and down sideways, so it's temporary. It's something that is unpredictable. Risk is where it's a decision that you made that prevent you from recover. Decision that you made that resulted in permanent loss, that is risk.
Okay, and does time horizon matter?
Yes, time horizon does matter as well, because time is basically like your engine, right? It actually power compounding, and it's also help to stabilize or it actually provides stability to your portfolio. Time can help you to improve your return, right? But the behavioral part is where is the control, is your steering wheel. So if you were to crash when the road gets bumpy, you're not going to get any further. And the control or the behavior is where, or I would say that time gives you the opportunity, but it's your behavior that determines whether you capture it.
Okay, I like that. So while you're saying that, let's bring that back to a fitness analogy, or let me give a real world analogy to wrap this volatility versus risk up nicely, right?
Okay.
So imagine a real life scenario where you break up with a toxic ex-girlfriend, right? So the toxic ex-girlfriend can hurt your feelings, but whether you choose or not to go back with her can affect your future.
Yeah.
Is that how you describe volatility and risk?
Well, yeah, I think I like that analogy. Yes, so it's basically how you react,
Correct.
to the circumstances.
So what I'm trying to say is that to wrap this up nicely with a bow, is that the market can hurt your feelings.
Yep.
But only your decisions can hurt your future.
Correct. That's right.
So now we got all our analogies out of the way. Let's move on to something a bit more real world application.
Right.
What do you think as part of long-term investing, why do investors trip up during this whole process, or rather during their long-term investments? What are these things?
So again, it's down to behavior. So I think the two main behavior that I notice very obvious is, first of all, is loss aversion. So people would try and reduce the amount of losses or pain that they want to see in their portfolio. The second one is in terms of herd mentality. So during market when market goes up, the fear of missing out set in. Right, so the herd mentality will kicks in, and then so most people would tend to buy high, because they saw everyone else is making money, so they may tend to buy high at that situation. So when it comes to when market fall, the fear of losing set in. That's where the loss aversion behavior take place. Investor tend to basically reduce the amount of anxiety in their portfolio by cutting loss. Yeah, so that may result in them not be able to capture back the recovery when the market recover.
Can you share a real world example and the outcome?
Yeah, that's a good point. So like, for example, if you look at the last 15 years, right? So I think the recent two market correction was in year 2022 during the COVID and year 2019. So at that moment of time, that correction will basically, it looks very severe, right? But if you were to look at on a multi-year horizon, it's more like a speed bump in your portfolio. Or in terms of the emotional trap, in order for us to be able to navigate this, is first of all to understand that we tend to have this loss aversion and herd mentality. And secondly is that what we can do is that we try and zoom out, focus or look at it from a longer time horizon. So when you zoom out, then you can see that actually it's just a small blip, and you may feel more comfortable in in staying invested to be able to capture the recovery.
Okay. So now that we've gone through what it is, what are the factors, what are the things that affect long-term investing, let's give everybody a little solution, or rather an answer to maybe this fundamental problem about long-term investing. Well, I wouldn't say problem, I'd say behavioral changes, right? So how do you then structure discipline? If discipline, I can easily say, I'll do another fitness analogy. I'll say every day I will run 5 kilometers. That to me is my mindset. But am I disciplined enough to do it? Maybe not. So if discipline is so important, how would you educate or tell investors to structure themselves to reduce maybe emotional mistakes, or to not behave in a herd mentality way, or to not let emotion dictate their decision making?
I would say in order to overcome that behavioral challenge, right? So what we can do is 3 things. So first of all is to make rules before your emotion take over. Secondly is to automate your investment. Third is basically to match your investment horizon with your goal. Yeah, so I'll give you an example. So for example, if let's say you know that you are a stress eater, so you will want to make sure that your house do not have the snack lying around, right? So those are rules, right? Rules. So similar, if let's say you know that you're going to be emotional about investment, let's say about market volatility, so you need to set the rules before that emotion can take over. And secondly is that most people may believe that timing the market is a better strategy. It's so hard to time the market, we all know. So rather than timing the market, you may want to set a systematic investment plan to gradually go into the market, right? So that helps you to avoid making daily decision, or regular decision with regard to when to go in and out of the market. So third is to match your investment horizon with your goal. Returning to the subject of risk, right? So actually, when we talk about risk, is also something that happened due to mismatch of time horizon. Like for example, if short-term money is investing in a risky investment, right? So that is a risk because we may not have enough time horizon to recover if the market doesn't move accordingly, right? So so basically, if let's say we have understand how long we are going to invest, then we build a portfolio, a diversified portfolio, and we have a strategy that is resilient enough to navigate through the market ups and downs.
Okay, so how does MYTHEO do this?
Yeah, so yeah, good question. So MYTHEO, basically, before we talk about MYTHEO, sorry, maybe what you can do to understand that actually what investors think when it comes to long-term investing, right? So from my experience is that when I talk to investors about long-term investing, there are 4 things that they seems to have some impression, or they seems to believe. First of all is that long-term investing require a lot of money, right? Because you're talking about the duration that you're going to stay invested, so it require a lot of money to do that, to start. So the fact is that actually you can start small and you can set up regular investment plan. Digital investment platform like MYTHEO basically allows you to start as low as 100 ringgit and set up as low as 100 ringgit per month regular investment plan as well to basically help you to participate in the market and eventually set our investment plan to achieve your goal. And second myth that I noticed what long-term investor used to think is that you need to time the entry. Entry point is important. So I've seen people that wanted to invest, but they hold back because they felt like now is not the right time to invest. So in the context of long-term investing, basically time in the market is more important than timing the market. So the third myth that I noticed is that diversification dilute return. The fact is that diversification helps us to sleep better at night, and therefore that helps us to reduce the chances of irrational decision. So when it comes to the long-term investing, there's another myth that people also seems to have is that long-term investing requires them to be more involved. Right, because if I decide to do something today to achieve my goal, the next thing is that I need to be more involved in my portfolio, let's say, right? But it's actually the opposite. Long-term investing is supposed to be something that is boring, something that is rule, that has certain rules in place, that basically require us to execute, to follow the discipline. So in fact, some form of passive investment vehicle like ETF is actually very suitable for long-term investing. It's because you don't have to worry about whether the portfolio manager or the fund manager of that ETF made the wrong decision, right? Because their strategy is to replicate the market performance. So that helps you to basically reduce one aspect of monitoring. So and with the other sort of mechanism in place, like for example, rebalancing, and also systematic investment plan. So that can basically help you to be a bit more passive when it comes to having a long-term investment plan.
Okay, I like that. So we talked about MYTHEO, we talked about how long-term investing and investors are getting affected. I think as a summary, how would you summarize all these things in 2 sentences? Give your thoughts. All right. If I'm coming to you, Simon, I want you to give me the breakdown of long-term investing in 2 sentences. What would it be?
First sentence is long-term investing is like planting a tree. You don't dig out the tree and see whether it grows or not every day, right? So second sentence is that planting a tree requires discipline, watering the plant, trimming the dead leaf, and then be patient, So that is the second sentence that when it comes to long-term investing, these are the 2 most important things is that you have to be, you don't look at it every day. And then what you need to do is to follow a set of discipline to ensure that you reach your destination.
I think those 2 sentences really close the gap and have summarized everything you talked about in this episode so far. And I think it would be fair to say that long-term investing isn't about staying one step ahead or being overly clever or too clever, right? It's not in a rush. You're not chasing trends. You're not chasing markets. You have to let your tree grow, right? And it's really about staying invested and disciplined, even when things come uncomfortable. Be comfortable being uncomfortable, or when things get uncertain or boring. If you follow through and steadfast, it isn't really about knowing exactly what to do at any given time. It's actually, maybe correct me if I'm wrong, it's knowing what to do when there's nothing happening almost.
Yes.
Yeah. So I think that really summarizes a lot about what we said in long-term investing. And I'm glad you shared your thoughts. I think the analogies were really good. Just don't get back with your toxic ex.
Yeah. That's right.
Okay. So that takes us to the end of this episode. We've talked a lot about long-term investing, the factors, the applications, the discipline. So there's one key takeaway. Don't forget, hold fast, steady strong, and don't be a sheep. So if you like what you see, don't forget to like, comment, subscribe, share. Maybe leave a comment down below what you feel is a challenge for you regarding long-term investing. As always, thank you, Simon, for joining us.
Thank you.
And we'll see you in the next episode.